de-risking exchange risk for about 5 minutes. And look, we've evolved a lot, and there are now a ton of solutions with very credible third-party custodians working with the biggest exchanges that are out there. And those are available, but they're not really being taken up. They're not really being used. I actually want to throw a curveball to the panel and just ask about what does the end state look like? There's a lot of projects out there building central clearing, reinventing the construct that we already know and have relied on in traditional markets for such a long time. Is that part of the solution in the end state, or is it something that's different? I don't know. I'm actually curious to hear people's opinions. I wrestle with this often. Is like, are we just literally just building the same exact thing with better plumbing? Is that the end of our job here, or what are people's thoughts on that?
Stefan,
okay. Yes and no. Yes, that will happen because that's where all the money is, and the plumbing in the old system is rubbish, but the idea is good. The no bit is when you go into the DeFi world, which is, we've started getting involved in things like Hyperliquid and stuff like that, and the innovation is extraordinary, and the things that are being developed in DeFi are just another level. They're so extraordinary, but they're incredibly complicated for anybody to actually use. And I suspect that world will invent some things that will probably take over from our old traditional world rather than something else.
My view is that it's probably going to happen for some asset classes and not entirely for everything, because I think there's a lot of moving parts here. We have the regulatory part, we mentioned that a lot, but it's also, sometimes there are other stakeholders as well. Regulation aside, right? If let's say you're talking about, tokenizing other things other than crypto, for instance, say commodities or currencies, then you have to get the central bank involved. The legacy system that they have that's globally used, CLS, these are not integrated to any payment system that the crypto world is so used to. So a lot of things, not everything will move at the same speed. Some of them actually with the benefit of, trying to push for efficiency, finality of settlement, like repo, for instance, may actually have a shot, right? So I think that it varies. And as regulation becomes clearer, as infrastructure is better and more system and providers coming in to breach that, I think that will happen. But I think it's a journey.
Well, I have a wish and then a more muted version of that might happen. My wish is that we can combine this. Why? I think self-custody and third-party custody is the first step on the way. And I especially say self-custody for individuals as well. If that gets integrated, I think that's a huge step forward. And if that's then integrated with TradFi offerings, great stuff. That is what I wish for. Because where crypto originally came from, and I'm still, let's say, part of this, is like maintain a certain level of control of your own assets, of your store of value. You can argue about that. I'm not here for ideologic reasons, but this is why I wish for it. And third-party custody, let's say, integration of self-custodial wallets will be a thing. There are compliance things, so not discussing that for now. At the same time, I believe that in the next 5 years, or 3 years, whatever, it's 5 years is a lot in this space, we will see way more progress in the overhauling of the plumbing of TradFi. With what's going on in the US, that's actually what happens. It's not about, actually it's not even about Bitcoin. It's about adopting blockchain technology to TradFi systems. That is what it's about. With that, there comes the ability to overhaul clearing mechanisms, to grant direct access for certain individuals, maybe not for all, but for certain individuals, et cetera, et cetera, et cetera. This is why crypto and Bitcoin was invented originally. So I believe we will see, if you look at the surface level, way more progress on that end. And this is where in the next 18 months, 24 months, everyone will look at. But I hope that we can integrate both, because there is, as you say, like there is a layer between centralized TradFi, fully decentralized DeFi models. There is a layer in between that has value.
And so my next question, and this is like building on top of everything you guys have just mentioned. It's maybe a bit of like a step back, but kind of curious, like what is actually driving a lot of this? Is it actually client demand? Is it cost considerations? Is it efficiency? What is, because we could always say, oh, it's all of that. And that's like a bit of a cop-out. But what is, like, in your own opinions, what are the leading drivers here? And so, Adrian, you want to...
First principles, it's always about user demand, right? First principles for anything. If there's a user demand, you build the product to try and service that demand. You don't try and sell a product that there's no demand or you're hoping there's demand. So I think in essence is that from Binance, we're always user-focused. So first is user demand. The fact that there's efficiencies behind it, that's an enabler of the demand. So that's pretty much where we sit. I think just to circle back on a specific point, my view on the overall markets, I'm generally an optimist. So to answer John's question, I think the end game is not only do we overhaul the plumbing of TradFi, we actually create a new world where there's a ton of new applications, a ton of new developments. It's just that the industry as a whole, we've come a long way, but we are still so young in the grand scheme of things. There's so many applications out there that have yet to be developed, that have yet to be created. The amount of brain power invested and youth and energy invested in this industry is tremendous. So I am very optimistic.
I think a lot of that energy has been wasted.
Oh.
Not the foundational stuff, but crypto's been really good at speculation. That's the number one use case for crypto to date. The plumbing and the ability to create programmable contracts is an enormous and extremely valuable thing. But we haven't delivered great applications. We haven't delivered, unification of systems. A lot of that just takes time, and there's regulatory burden. There's, all of that stuff, and it's all coming. So I don't want to be. It's actually not a negative statement, but it's a fact. Like there's a lot of good salespeople and marketing people that have raised an enormous amount of money and not delivered a lot of value back to their investors. That's just a fact. I'm also beyond optimistic. I'm certain directionally that this will move towards the efficient frontier of how to operate. We'll move towards the efficient frontier of competitiveness, where consumers are the winners, and ultimately sovereigns get cheaper and universal access to an enormous menu of investing options, where there are gatekeepers and barriers that frankly don't exist for any reason apart from trying to keep market share, in one ecosystem. And that's going away. That's going to take a while. Even now, we're talking to 50 banks. A lot of them in the US, talking to regional banks all over Asia, all over Europe. Their impetus is to how do we win? How do we win crypto? Oh, that's the wrong orientation. Like the market wins, the consumer wins, the investor wins, and some of the incumbents that charge big fees are going to have to be competitive with
I think you're wrong, folks. I think you're wrong. I think that the banks will always win because if they haven't done it themselves well, they'll just buy it because they've got all the money. So if something really good comes along, they'll just buy it. So they'll always win.
Building on, I think for us, what drives this demand is our client. Oh, sorry, you want to go? I'll let you have your way. But I think more importantly, if we look at crypto trading for our community and our exchange customers, started off with our financial institution who are very good at trading basis, right? So they see the opportunity in the market, they dabble into it. And as liquidity builds up, our hedge fund participants in our market start looking at it and say, hey, this is actually a big macro trade instrument. So they got excited, they join in. Asset managers trying to be competitive are also keen to basically participate. But, there are some restrictions, right? For example, asset managers cannot hold spot crypto for some, and therefore they have to trade other things to have exposure, like a futures or a perp, for instance, right, on a regulated environment. And then obviously corporate will come in to try to basically build on the yield, build on the whole borrowing and lending, and that's how our ecosystem from the TradFi will actually evolve from terms of demand for this crypto asset.
Last word, good sir.
Yeah, let's look at demand, but from a slightly different perspective. We just have a few seconds. I believe, again, it's room for all. And you need to delineate between trading and investing. Investing probably will be TradFi dominated because it's working with other people's money. This flows into trading indirectly. Direct trading, you see it already in TradFi, is a retail game these days. Full stop, and it will be in crypto, and I believe that is here to stay. We have that in DeFi, and we have that in the bridge between the two.
We will have to close it at that. I think we're going to continue this conversation in the back. We are not done here. Well, with that, I want to thank all of you for being here today. Thank you to the panelists for a wonderful discussion, and look forward to seeing you all next year. But with that, round of applause for this wonderful first panel.
Brilliant job to the panel. Brilliant job to our moderator, Sheldon Hunt. Thank you so much, gentlemen. Oh, we're going to get you for a photo right up in the middle here. Yeah, that's right. For those of you in the audience, we've got roughly 10 minutes, maybe 15, but go grab a drink and get right back in here. Maybe make one new friend, not 20. One new friend and get back in, and we're going to have some more action for you. We're bringing you the biggest names in traditional and tokenized assets. So please, we'll see you back in here in 10 to 15. We've got a break brought to you by Avelicom. So thanks to Avelicom for buying everybody a coffee. Thanks. All right. And with that, we are back in action at Liquidity 2026. Earlier today, I talked about the thesis, the antithesis, and the synthesis. And if digital assets, tokenized assets, and traditional finance are going to come together, they have to learn how to talk to each other. They have to learn how to transfer assets from one place to another, melding or merging, or at least building a bridge between the different ways that we account for ownership, as things move back and forth. And so we're going to be talking today about clearing, custody, and the interoperability of markets up here. To do this, we've got a dynamite panel for you. First up, we've got as our moderator, Coco Tong. Coco Tong, who is joining us from The Block, is bringing, again, mighty fashion to the stage. There seems to be a theme of the day here at Liquidity 2026. She's going to be joined by Andrew Robinson from Coinbase. I'm a customer, one of the heavyweights of the crypto world. Ian Lowe from Cefu is going to be right up here on stage, helping to make the action happen. It's a double Tong. Of course, I said we got Coco Tong moderating, but we have Amy Tong from Fireblock, who's going to be joining our panel, along with Darren Jordan of Komano. So ladies and gentlemen, that's your panel, coming to talk to us about what's going on and how we put these markets together. Coco, is your team ready to go? Yeah, let's get them up here on stage. Let's go, guys. Let's hear it for Coco Tong from The Block. Thank you. And here they come. All right, ready for action. There we go. There's Mr. Robinson. Another Andrew. We like that. Yeah, good stuff. Good to have you guys up here. Thank you. Double Tong and Darren Jordan. Thank you very much.
Hello, everyone. Testing. So I'm Coco. Nice to see all of you here. Are you guys having a good day? Yeah? Who was here last year? Yeah, I was here last year as well. And then, like, everybody was just talking about is institutions are going to move into a crypto world. And nowadays, we're talking completely different scenarios here because we're now seeing all the institutional players are full on crypto and digital asset. So before I move on, I just want to have a quick introduction of myself. I'm Coco. I'm working at The Block as an APAC director. And next, I'll move the spotlight to our guests and panelists. So Andrew, when you want to do an introduction to our guests?
Yes, thank you. So Andrew Robinson, based out of London. I represent the institutional business for Coinbase in EMEA as well as APAC, and I've been with the company for the last 8 years.
Morning, everyone. I'm Ian. Heard that this has been a good event for the last 2 years. That's why I'm decided to be part of this. I run the global crypto custodian for the world, connecting to some of the largest exchanges, and happy to be here.
Good morning, everyone. My name is Amy, and I lead the Fireblocks APAC business and been with Fireblocks for almost 6 years at this point. So it's been a long journey and very excited to be here.
Hello, everyone. Darren Jordan, Chief Commercial Officer. Been with Komano for now 3.5 years, in the regulated digital asset space for 8.5 years. Komano is a regulated custodian, off-exchange settlement, staking. It's a pleasure to meet them.
Thank you. Thank you for being here. So yeah, let's just dive into the questions today. So they're obviously very forefront at the new ecosystem, forming the new rules in digital asset with the institutional. And so for my first question is, in terms of institutional skills, do you see that settlement as a bottleneck at the moment? And what kind of things do you think need to be changed? Or what's the biggest challenge you face in terms of settlement during your work?
I think that like settlement as a bottleneck is like when you think back to like where we came from, like with a custody from a custody perspective. Custody was largely just cold storage, right? A lot of it was just like hold my keys and that's all you can do. And as like it's evolved, it's become a lot more than that. So custody has become more of like the operating system that allows for like the settlement and also for clearing and almost like the next gen system for like financial infrastructure, right? If we're going to continue to tokenize all assets. So that bottleneck has to be released from just pure, cold storage, hold my keys, I can't access it, to the ability to like manage the on-chain financial life cycle of all these assets that we're trying to use for cross collateral and for different like use cases and purposes, whether it be stable coins or tokenized credit funds or money market funds or whatever it may be. So I think that really that evolution is what's key that we need to see happen in real time and continue to evolve in a way that also reduces the counterparty risk.
Ian, do you want to talk about it?
I think from settlement perspective, I would not say that it's a bottleneck. It's just that crypto is a new industry as compared to the TradFi, right? The challenge is trust. The part of the TradFi connecting to the Web3 world, I would say that is, we need to find a way, right? We need to find a way with the exchanges as a custodian together with TradFi on finding that balanced approach on how to make it as seamless as what the current TradFi models has. So fundamentally, I think from my perspective is how do we create that trust and how do you build that trust? Apart from using solid legal fundamentals agreements to safeguard that, and on the other hand, from a technological perspective, how do we put it on chain, create a smooth clearing settlement, and to ensure that the tokens are able to move to where the clients needs them to be. So I think that's from my perspective.
I would say for settlement, a lot of times with the crypto natives is an opportunity. Majority of the funds today that are operating pure crypto space actually take advantage of the fact that you need to go settle assets to and from various different exchanges. There are a lot of challenges associated with that, and therefore they actually make quite a bit of money, whether through cross-exchange arbitrage or they figure out a way to really fast, efficiently, and securely to manage their withdrawals, and various different solutions that we have helped clients develop over time, and that's been a great opportunity. But now, if you look at what's happening in this industry, a lot of the flows are actually happening unrelated to blockchain, right? A lot of flows are coming through ETFs. There are derivative products being built on top of traditional financial infrastructure. Actually, as that industry develops more, a lot of the settlement risk, quote unquote, that happens at a blockchain to exchange to custodian level actually will get removed as more and more of these derivatives products that is traded via traditional financial institutions. You could ask the question of like, is that really good for the industry if everything trades it as an ETF or as an options product settled by CME or wherever? Like, what's going to happen to the actual blockchain value, right? But that's the reality of what's happening now. More flows are happening on the derivatives market than they do on chain.
I think the other panelists mentioned some really interesting points. I think if we're bringing blockchain, crypto to institutions, we've kind of got to align with the way institutions think. Now, I previous to digital assets, I was in literally TradFi for 30 years, and if you said to any kind of fund or asset manager, park your assets with an exchange, they would look at you in a very weird way. So I think we need to kind of have a hybrid solution where we work with clients to provide an institutional settlement solution that allows clients to work with exchanges, let exchange be price discovery points, let them be the masters of connectivity and order books, but let the custodian and the settlement layer effectively join the dots and reduce counterparty risk. That's where we see it, and I think initially we started with crypto. We now move away into different areas that include using digital assets for collateral. So it's not just connecting exchanges for settlement layers, it's also connecting other parts of business, whether it's lending, and obviously we've got real world assets, you have repo trades potentially going on. They all need to be settled in a way which is reduction of counterparty risk in a safe, compliant way that institutions understand. I think that's the key here.
Yeah, I think we have talked a little bit, according to Darren and Amy. Right now, the custodian models kind of have to also be evolving with more multi-asset kind of involved in, including U.S. Treasury, tokenized treasures, right, and then ETFs and RWAs. Do you see any changes on the custodian models right now that you're working on? Amy, you want to start from that question?
Yes, I think there's a lot of changes happening. So, for example, you're seeing a trend with the retail fintechs. They're actually offering non-custodial wallets to their end retail users. And the reason being is wallets are difficult, compliance is hard, and for a lot of retail users, for them, actually being able to hold assets themselves and eliminate some of the bottlenecks of using MetaMask and using, let's say, Trezor or Ledger actually brings the next billion users onto the blockchain space. So we're seeing a lot of retail fintechs are actually coming up with non-custodial wallet solutions and allowing users to get access to prediction markets and all the different solutions. So that's on one hand that we're seeing happen. On the institutional side, I actually think a lot of institutions, to be honest, don't care if they self-custody or third-party custodian. At the end of the day, I think first and foremost, unless there's a regulatory requirement where they need to leave assets either with themselves or with other third-party custodians, they're actually looking for sets of functions and features that allow them to really efficiently manage their workflow. So for example, obviously on October 10th, when clients are really like having difficulties moving assets around in high liquidity situations, they needed to have a solution that allows them to ultimately their wallets are going to determine whether they make money or they lose money on a day like that. So that still happens in our industry, and I think a lot of institutions still really care about it. And then for the TradFi folks, I think a lot of traditional finance definitely wants to do what they're familiar and what they're used to. But a lot of the smart TradFi money actually are demanding a lot more from their wallet or custodians because they also see it as an edge to help them ultimately make more P&Ls as well.
I think Andrew raised a very valid point. Back in the day, custody was just really park your assets in cold storage. There was no utility. You couldn't do anything with it. Generally, most people just sat there. Suddenly now we've got this concept of actually you can do a lot with it, but you don't have to give up risks. So we've been spending a lot of time on the whole collateral management piece. And to your point, I think it was interesting when you say institutions don't care self-custody or managed custody. I think there's a world where they both coexist. Many institutions we talk to, they explore the self-custody model, and to be perfectly honest, they find it complex, challenging. The responsibility of key management backup keys is quite a daunting task if they don't have that experience. So for us as a regulated custodian, we've got all that layer around that. But where we think the biggest future now lies in utility around the assets, and that comes in with collateral management, settlement, but also working with partners that are creating real-world assets, tokenized real estate, tokenized money market funds, tokenized anything, using that as collateral, which then leads us into kind of DeFi. We need to bridge the gap between wallets to be able to support DeFi and the regulatory framework that will allow a custodian to participate in that business. And that's coming. There are some interesting conversations with regulators. They're starting to grasp the concept that on-chain vaults, they have some interesting concepts. They need to get their head around the AML concept, but there's definitely movement in that area.
I said it to Darren's point. The line is blurring between like the choice between self-custody and third-party custody, as well as like the line between crypto custodians, right? Which a lot of us are crypto-native custodians, and then also the traditional banks, right? So those lines, I think, as the ecosystem continues to mature, will blur more and more and kind of look like one versus these two distinct ends of the spectrum that we still see to some degree today.
And what is the approach in Coinbase when you're settling different custody models and multi-asset? Is there any special approach to it, or?
I think that there's the approach depends on the client, right? Ultimately, and what the client needs and what the client wants. But when you think about the, I guess, multi-custodian or provider question, it's really one of what are you ultimately trying to solve for? And if you're a hedge fund, or if you're a bank or a broker, is your core business the complex cryptography of custody? Is it worrying about the next protocol that's going to come out? Or is it generating alpha or delivering a killer UI that's going to enable prediction markets or whatever it is? So I think that coming at it from that perspective, do you really want to spend your time on core infrastructure, or is that just more of a distraction for what you should be really focusing on day to day? And I think that for most clients, they realize that, to Darren's point, they start, I want to do self-custody. And then they're like, okay, I'm going to get a on-prem solution. I'm going to do this, I'm going to do that. And then they realize that my time to market is going to be a lot longer, and I'm going to be stitching together all these different providers, and that's going to increase enterprise risks and make it a lot more messy, right? So I think it really depends on what your first principles are as the client, being whatever client segment it is, in terms of what you're trying to achieve.
I think the hedge fund industry also is another very interesting one, because arguably they are presenting their strategy to the investors. Having a solution that is regulated sitting at the back end is kind of a nice tick box for them. So I think, to your point, it allows them to say, well, we're focused on trading, generating alpha. We're not kind of looking at the noise around how to hold keys in it.
I think that also too, if you don't solve, if you have all these different counterparties that you're stitching together, you just create fragmentation, right? And so with that, you increase risk. And we also want to happen like on October 10th. And so if your collateral, if your assets are trapped on one exchange, when it's under stress, then that mobility becomes harder. And then you start to think about things, Darren, from like that we're familiar with from traditional finance, like cross margining, right? And so again, there's a cost to just have your capital siloed within one custodian or within one exchange. And so what we're seeing, or what we advise clients on, to your point, is more about the prime brokerage model and kind of bringing the traditional prime brokerage model to crypto in a real way. I know that there's a lot of attempts to do that, but that really does allow the instant settlement and movement of collateral and to be recognized by different venues in real time.
Yeah,
If I can add on to both gentlemen, I think we, from Safu, what we do, I think at the end of the day, we started with co-custodian. Should it be self-custody? Should it be the keys should be held by themselves, the clients, or should it be held by us on their behalf for operations? We have gone past that. Reason, because we know that there is a demand in the market to move out of, apart from having the assets that are safeguarded, there is an operational aspect of should it be self-custody or should it be something else? And that's why we start to pilot the program where we connect to the exchanges to bring value or yield to clients that they want to use that. And that goes back to what Darren's saying, because that's where the prime broker comes in, work together with custodian, and with that, the custodian will safeguard the assets. Trusted prime brokers from that perspective, prime brokers will generate yield for the clients. And where does the prime broker go? And it goes to the various exchange. And that's how we start to run it, to make sure that, first, we make sure that the assets are safe, secured. We help them to solve the problem if they do not want to have that operational, I would say, bottleneck from that perspective. And then, after the funds are safe, how do I generate yield? I mean, if you go to the normal TradFi model, I will generate yield in my CASA account, my cash account, and after that, I will start to put into a wealth account to get it managed. And that's where the prime brokers comes in, and that's where they go to the marketplace where the exchange decides to do that part of things. Of course, on the other hand, there will always be the DeFi angle to things. I'll leave it as it is, because DeFi is something that it is not so widely accepted from a CeFi model at this point. But if you talk about how crypto custodian evolve, this is definitely where we are heading to.
Yeah, and I agree with that, right? So like, particularly like at Coinbase, we realized that that bottleneck, right? So there's no secret that we custody a lot of the assets for the large ETF providers. But what we quickly realized is that there was an underserved client segment, being the crypto native hedge funds, the VC funds, high net worth individuals that were like, hey, like we want our assets to be held in a qualified custodian with like the same like policy engine and controls in place and insurance and SOC certifications, but we want to be able to access that DeFi, the world, or the on-chain world, right? So it's almost like you do that at your own risk, but like we can provide that same institutional framework and infrastructure that allows you to access it the same way that you would your cold storage or your other trading or staking functionality.
I think prime brokerage is a very interesting angle because it solves a number of issues, specifically around exchange connectivity, cross-margining. The one thing to be aware of, certainly from coming from a traditional finance background, the balance sheets are not totally there yet. So merging that with a custodial solution to allow a pledge to a prime broker, that solves that problem. So I think that's the angle that the industry is going down at the moment.
But it's not like a balance sheet issue, it's a volatility issue. So if you actually broke down to why prime brokers don't really exist and can't really cross-margining across biggest trading venues for crypto, if you look at where the liquidity are currently being captured, you got the Binance, OKEX, Bybit of the world, who ultimately require you to pre-fund all of these venues. So it's a really balance sheet intensive, but ultimately the volatility is too high for anybody to come in to really properly assess the risk of doing cross-margining. And then you convert it into the other side of the coin, which where all the ETFs flows are happening, which is settled in a very unique and a really different way than how the Binance and OKs are being settled. So as a prime broker who will have to come in to manage all these different risks, and with the volatility that we have in market in crypto today, with the leverage that exists in the system across various different venues, it's very difficult for them to raise balance sheet to support that business model. And eventually they'll run out of money to manage this. And we've seen this happen in our industry where the biggest bottleneck for prime brokers to scale is access to balance sheet. And that's not because they don't have balance sheet, but just rather the market itself is so volatile and so complex that no real proper like balance sheet funders look at this business model and be like, yeah, I'm happy to go and fund your balance sheet and make 20%, 10% on the balance sheet itself. That's really high risk for that money, right?
I still think it's a balance sheet problem. I tell you why, because there's a number of prime brokers out there that need, when you post collateral with them, they need to rehypothecate it. They have not enough balance sheet to deploy in the market. That is your risk, because your assets then title transfer to that prime broker. You're taking full counterparty risk. There are few out there that we work with that don't need title transfer. And that is a very interesting element here, because you can park your collateral at the, I don't know, tokenized money market fund, generating yield. They've got a lien on that, they've got a security interest on that, but they're not taking title transfer. You still remain the beneficial owner. That is a huge positive. Not all prime brokers can do that. There are a number out there that need they will take your assets and rehypothecate because they don't have a balance sheet themselves of significant size.
And I would say that's like one of the problems, right? Because you have these like intricate webs of bilateral arrangements, and like as long as you still have those bilateral arrangements, like you're not getting a true capital efficiency, right? So you have to break down those silos in order to like solve the balance sheet problem and also like the collateral and asset mobility problem. Bilateral, it's slow, it's antiquated.
Yeah. And you're absolutely correct. And that's the reason why I think when you start to look at how to have that balance sheet and to be able to have that liquidity to be able to run that, I think no one should be bearing the risk. Shouldn't be the client, shouldn't be the custodian, of course, shouldn't be the exchanges, definitely shouldn't be the prime brokers. So I think then the question is, what is the kind of framework and the rules that we need to put into the market by the various major players that we can make it fair for everyone. Nobody taking additional credit risk, nobody taking unnecessary risk. And when there are bilateral arrangement, that's something that it is not as transparent. So in crypto, we want to be transparent, and we want to make sure that there is a model that is sustainable. There's no individual risk that will be taken by any party within the chain unnecessarily. So I think that's important.
But that model will never really exist unless you go fully funded through a dollar-based product or like a fiat-based product. The second you have got is, say, a coin-based, whether it is Coinbase, a token-based, whether it's Bitcoin, Ethereum funding as your collateral, ultimately, whatever you obfuscate the risk, there's no backstop. You can't print more Bitcoin. You cannot print more Ethereum, right? Like ultimately, if you look at how the financial models and financial industry works in a dollar-based system, ultimate backstop is government backing, right? Like you can always, whatever bank blows up in the end, they can get bailed out. And there's a backing to which that risk, if it's mismanaged, there's a backstop to this. Versus in the coins world, and if you're looking at anything using Bitcoin, Ethereum, ultimately, as the collateral, you cannot really obfuscate that risk to someone, which means that that risk has to either be distributed across the participants, the venues, the custodians, or something other form of the likes to really distribute that risk, but you can't really obfuscate it in the, call it coin version of this kind of balance sheet management.
Yeah, it is very obvious to the audience that it's a rather complex system, right? And like everybody has a role, and in terms of the infrastructure building, we're still doing it, right? It's slowly, step by step. Are you guys also working with third parties, infrastructures, and what kind of roles they're playing in this, complex system in terms of reducing the fragmentation, the operational?
What do you mean by third-party system?
Third-party infrastructure that helps to reduce the operation fragmentation in this complex system.
I can take that one, because so as a regulated custodian, we actually use a number of different back-end technologies, one of them being Fireblocks. Now, why? People say, why not just build your own? But you have built-in redundancies by using multiple different technology stacks, but also some clients want cold storage, HSM, some clients want MPC, some clients want a long list of supported assets, which may be not available on one technology. So This is not that we just say, oh, we'll just hand over that responsibility to that vendor. We build on top of it. So it becomes the security that forms the base of everything we do, from collateral management to also just vanilla custody and staking. And then we build our own governance layer, API, and all the technology on top of that, and then the regulatory wrapper. So I think, for other custodians do it differently, but you then have a single point of failure. When that technology fails, people can't transact. For us, I think having different technologies, different vendors, that is, yet again, you're working with partners rather than kind of absorbing all that responsibility, but always having that governance at the top.
I think that we take, I guess, a slightly different stance. It's like a little bit slightly of a hybrid approach depending on how you consider outsourcing. Like when it comes to our core prime brokerage product, of which custody is at the heart of, that's our own infrastructure. Of course, there's Amazon Web and things you have to bring into it, right, if you're using it. But it's everything that's owned and operated in-house. But because we're very keen about fragmentation, again, capital efficiency, which has become a big theme, when it comes to liquidity, we connect to multiple different venues, right? So bringing the idea of best execution to crypto. Things like staking, we work with third providers to make sure that there's also one single node that becomes a point of failure. So a bit of a hybrid approach depending on which element of the prime brokerage services that you're speaking to.
We adopt that model like you guys, right? Or even Comino is the likes of, we believe in the right people do the right things. This staking companies, Figment, Guild, and the stuff, we talk to them, we provide the additional services because we focus on our core, which is pretty much on custodian, core custodian, hot custodian stuff, and we will be connecting to them. Those are the third parties that we use to generate additional yield for the clients. I think the other one that I see, and I've been talking to a couple countries on building, and we will SAFO to become that third-party custodian for the countries to be able to help them with the infrastructure that's going to be built. Because the largest thing that we see is most country, if not all, believes in the HSM technology, which has been used for hundreds of years or tens of years in the industry. The question is, how do we get a breakthrough on that? We work on having that hybrid approach to have something that they are comfortable with, something that from the crypto world perspective, we are comfortable with, and to have that hybrid model. I believe four of us here on this panel, we have been thinking hard to find that breakthrough of where we are of this traditional finance perspective. Because we do have to believe that we have to break through. If not, there is no way there's no way we can make it bigger for the industry and to be that module between the TradFi and the Web3 world.
I would say the worst model you can operate is probably if you operate in the UK, you have one set of stack that helps you to manage. If you go into the US, there's a different separate stack. And if you're in a place like Hong Kong, that is a completely different set of wallet stack, whether it's custodian or not, where then your team needs to learn how to manage all of that. It's probably the worst model. So in general, I think where the industry is going towards is you can have this operational layer that ultimately allows you to connect to exchanges, connect to custodians, connect to your self-hosted wallets to get you access to DeFi and the various different components, but that operational control sits on the client side. And on the back end, you can be pretty modular. You can swap out different custodian, you can swap out different key technology, whether you want to do HSMs or MPC or whatever versions that is out there in various different jurisdictions, but ultimately the control panel and the control center is managed by the customers, and they can decide what is most suitable for them. Because also I think unlike traditional industries, like the crypto industry is very global, right? You speak to the customers, they're not just operating, they're usually operating in 10 countries at the same time, all have different sets of regulations and requirements. For them, it's super important to have that control center that controls everything, and then get them access to compliance, travel rule, which is a really big topic at the moment, where everybody's trying to figure out, and that in itself is super fragmented for people to comply to. So generally, I think your question around do people use third-party technology? They have to, right? It's impossible for a firm to build themselves, and that includes some of the largest firms, which is usually the retail exchanges and the institutional exchanges, all the way to your, two-man in a garage in trading tons of millions of dollars of crypto. In this day and age, I feel like a lot of the technology is there now. People have to use third party to get them best-in-class solutions.
Would you say this approach is quite standardized across different countries? As you have mentioned, this solution has to be kind of standardized, but obviously we previously mentioned that clients will have different needs. How would you kind of balance out that standardization and flexibility there?
So most regulators care about AML. Most regulator cares about compliance and control. Some regulators have specific requirement around the technology itself on where to store your keys. Generally, regulators have choices around temperatures of the wallet, right? If you look at from that perspective, a lot of this is actually, even though they operate across the different globe, the nuance really comes into the back end, which is like where your keys stored, what technology used to store those keys. But the compliance, operational tooling, all of that stuff usually is pretty standard across the jurisdictions. The trend that we're seeing now, as we call it, is called a journey to the West, right? We're like literally West relative to Asia. So essentially, we have a lot of clients who are now effectively applying for the MiCA license, trying to be in Europe because it's a 400-something million population market. It's one license to get you access to 20 different countries. Like a lot of people going for that route. And that's a trend that we're seeing kind of moving towards that direction as well.
I think like one of the biggest things from a regulatory perspective that probably makes the life of a custodian hard when it comes to jurisdictional responsibilities is like if every country or geo goes the route of like you have to have like the private keys or servers like in country, right? Because then to your point, that doesn't give you any scale, and then you have the same thing that you have in the US, that you have in Europe, that you have in Hong Kong, that you have in Dubai, et cetera, right? So I think that that's one of the big whack-a-moles for custodians when trying to think about their right-sizing their global footprint.
And then you got to put balance sheet on the side to get the
capital
license.
against that.
So there's like a lot of challenges I see folks are facing, but at the same time is where the opportunity is, right? Like I think in places like Hong Kong, where it's currently going through really positive regulatory regime, clients are coming to the space and seeing that, hey, like there's licensing to be had, there's opportunity for us to go and operate, and let's take advantage of that and be the first in market and ultimately pick up majority of the flow that you see in a particular country.
Yeah, and it seems like there's a lot of risk involved, right? Because there are so many parties involved. There are third party, there's infrastructures, there are so many parties involved. How do you see the risk ownership in the process and in terms of clearing, custody, and settlement?
If I can take that, I think back to what Amy was saying, that there wouldn't, from a balance sheet perspective, there won't be a single way of balance sheet or solution to that. I think second thing, we know that operating in different jurisdictions, we need to have that operation layer, the single operation layer that is able to help us to simplify things and make things fast. At this current moment, yes, these are all dreams, a vision that we all want to have. The question really is, at the end of the day, we just have to be that good corporate citizen to be able to run that, to be able to understand the risk on each individual component, clients, banks, custodian, prime brokers, exchanges, hedge funds, whatsoever. The full suite. Everybody needs to understand the risk because single point of failure will just crumble the whole process and the whole model that is being set up. And we are running in a very complicated model. Everybody is trying to do their best, and with regulatory enforcement that is being put up in every single country because they have to protect their residents or the businesses. So then the question really is, how can we work towards that? And I would say that it will take a long time. We need more time to make sure that the public and private sector are aligned so that we can have that mechanism to eliminate, not to eliminate, but to bring the risk to the bare minimum that is being able to be tolerated by the users of the framework.
I think you just look at standard diversification, right? We see it in traditional financial markets. We see it here, whether it's diversification of technologies at the back end, whether it's being splitting assets across multiple jurisdictions from a regulatory perspective. The list goes on and on. Certainly from a custodian perspective, we have to prove to regulators that we have control. So if one of those technologies did fail, that we still have the ability to recover the assets and move to another technology provider. That's kind of it's the standard diversification model that we see time and time again. That is how you manage the risk of different vendors. And obviously you have very high stringent requirements for SOC audits, et cetera, and you periodically do reviews of all the vendors, etc. But ultimately, it's diversification.
Okay, kind of like we're seeing a lot of progress right now, and obviously you guys are working very fast on progressing those things. My last question would be, when do you think that will be a signal to say that, you know, the whole system will be matured? What are the signals? And obviously you guys are working hard. This is something that we talk about that would happen in the future. But what kind of milestone would you see that's a signal that's a matured whole system of like tokenized industry in your institutional perspectives?
Yeah, so like when will the system be like fully updated, I guess, is the way to frame it. And I think that like, probably like once things like T+1 settlement goes away, right? And so on-chain DVP or delivery versus payment becomes not just a proof of concept, but something that's boring that we no longer mention. I think that that's like kind of like where the reality of like clearing and settlement and everything has gotten to a point that this infrastructure allows us to take it to. The second point of that I would say is like that coupled with like stable coins, right? And so when stable coins becomes more than just, you know, trading settlement and is, again, we're seeing it in real time for like collateral management, for the use of real world assets, for trade financing, for deposits, et cetera. And that there's the regulation, be it MiCA, the Genius Act, whatever, that supports it so that it can be viewed the same way and that we're seeing it tied to like real world economy use cases and not just like some of the trading volumes that we've seen today. So the two things between the way we think about DVP and the way we think about the use of stable coins or in general all on-chain assets for settlement.
I think you're right. Because other thing that I see is, apart from Genius, Clarity, MiCA, Hong Kong's regulations in Singapore, Dubai, these are the major jurisdictions that's taking the forefront. That consistency has to come. As long as from a regulations perspective, we see that there is going to be a push for improvement and progress, I believe the market players, the industry players, the leaders will capitalize on that and we will start building towards a more, make it an environment that is pretty much going to have more adoption. I think it's only from a regulation perspective that we can do that, because if not, industry leaders and players pretty much will be stuck at this current point. And we are really stuck at a certain point. We can only do in small scale, not scalable, and that's pretty hard to have a significant breakthrough from that. So it's only through regulations that I believe that we can move forward.
I think if you look at indicators and signs, you asked the question a few years ago, people probably will agree that, oh, when the institutions come in, that'll be the sign the industry is ready, right? That's a really boring outcome, in my opinion, because if the world goes back to there's only 4 custodians that ultimately holds majority of the assets and it's US-denominated story, and we go back to the same realm that we had in traditional markets, I think everybody in this room would be quite bored. So I actually think the opposite, which is the convergence between crypto folks launching traditional regulated products in traditional markets, and at the same time, the regulated traditional players offering crypto products. You've seen this happen already on both sides of the pond. That actually, I think, is a more exciting outcome, because to me, we used to think that institutional adoption is the customer, but actually institution is the competition. And that, I think, is a way more exciting view for the future to come, where you see crypto players, or I say crypto native players, are competing head-to-head with traditional institutions in markets that they both were previously operating in. That, to me, is signs of like, what is institution ready, when are they all happening? Because that means us as the industry has matured enough to operate at a playing field that has historically been dominated by a few players, whilst they're also coming into the crypto industry to go and access to liquidity and so on and so forth.
I think for me, what is a positive sign is custodians working together. I think if we have a world, as you just said, that 4 custodians, that's the big 4 out there, we all know who they are, as in TradFi custodians, you lose innovation, right? These guys can't move quickly. Crypto, digital assets is an industry which moves ultra lightning fast. That would be a disaster. So I think, for me, the success or measure of success would be collaboration between custodians on a settlement layer, to allow, ultimately, what Andrew mentioned, T+0, instant settlement or near instant settlement. We're not just talking about crypto, we're also talking about tokenized real-world assets, we're talking about equities, etc. That is the massive game changer. If we get that to T+0 in the traditional financial market industry, then it revolutionizes the movement of money to a 24/7 where you need more than 4 custodians because you need innovators in the market, and it's not going to be the standard, the usual suspects.
Are you see that coming soon?
It's being worked on. It's being worked on. There are a lot of pilots out there right now. Because people say, why are you tokenizing assets? What's the point? There's some weird stuff with regards to you have to run dual registers because regulation's not caught up yet. The ultimate objective here is to get near instant settlement. And the capital efficiencies alone from moving T+2, T+1 to T+0 is huge. You then overlay that with collateral mobility, that is a game changer because the whole counterparty risk reduction plays as well.
From our perspective, we try to pilot on that. I think with a couple of the RWAs token, likes of Buildo and USYCs, and absolute, that's the problem. We look at it from a traditional settlement and clearing itself is T+2 or 3. We cut it down to T+1. Then we need to look about T+0. But this is only from a collateral perspective. The question again is, what can it be translated of having a tokenized money market fund to make it into a token or an instrument that we can put it into an exchange to be able to get yield. So this is always something that we are trying to get a breakthrough. Like I say, we can't do something that is on a big scale when we don't have the support. And these are some of the things that we are trying to pilot. So to your question, if it is happening in small scale, but not exactly that big.
So, it's already T+0. So I'll give you an example. For NASDAQ New York Stock Exchange right now, it's settled for T+0 on Fridays. Everybody in this room who work in traditional hedge fund in Asia are waking up on Saturday morning to clear their trades. That's just life right now. And you look at the software vendor that supports the Asia-based hedge funds, they're figuring out how do I do batch trades and all this stuff on Saturday morning. And actually, if you look at the crypto industry, folks, we're already used to this, right? We're used to 24/7 trading. On the weekend, it's fully automated. I actually think that it was interesting when we talk a lot about T+0 and the settlement happening internationally, but actually that's why I think the crypto industry and digital asset industry is perfectly suited to trade traditional markets as they go into T+0 because our infrastructure is already set up for that kind of world of settlement speed.
Yeah.
You have more decimal places than they do.
The tokenized money market funds is a classic example. Right? There was some liquidity in that, but on a Friday night, you can't redeem the full amount until Monday morning when the underlying market is open. So it's dragging that traditional market infrastructure into the world of digital assets, what we're all working with right now. That's the challenge.
Okay, great. Thank you so much for sharing this comprehensive perspective with the audience today, and we're really glad to have you. Thanks for sharing again. Let's give them a big round of applause to thank them for sharing this amazing insights. All right. That's all for today. Thank you all.
All right, wonderful job, Coco. If we could get you guys in for a photo right up here in the front, there you go. Tight, there you go. Come in close. You're all friends now. Fantastic. There we go. Thank you so much. Coco, you did an absolutely magnificent job, as always, moderating this panel, for which we appreciate it. There we go. All right. Thank you very much once again. All right. As we all head off, thank you very much. There we go. Love another Andrew? All right, good stuff, Coco. Great job. One of the wonderful things about crypto is has always been the idea behind it that we are democratizing investment, democratizing finance. Outside of crypto, there was a company that really embodied that. A pioneer, we would have called them a fintech firm, and of course that was Robinhood. And later on, as somebody who came in and kicked over the apple cart of traditional finance, they later said, listen, we're joining the crypto party. And so we're excited to hear from them today about how they are going to bring the next 100 million investors into the party. We've got a little fireside chat set up for you now. And we have Sean Lee, who is the founder of OSN, one of the leading lights of crypto right here in Hong Kong. He's also a contributor to Forbes, so if you like what you hear, you can check him out on Forbes to get more of his thinking. But he is going to be interviewing Johan Kerbrat, who is the Senior Vice President and General Manager of Crypto at Robinhood. He's an engineer's engineer. He did it at Airbnb, he did it at Uber until Robinhood said, we have to have this guy. And he rose up to SVP and General Manager of Crypto. So please welcome Sean Lee and Johan Karbratz. Please. There we go. Take it away, gentlemen. All right. Go get them.
All right. How's everyone doing today? The first day of Consensus Week, so lots of activities, lots of guests coming into town, including my guest of honor for the fireside chat here. So let's talk a little bit about this particular topic, right? 100 million investors. Maybe what we start with first is 100 million users, right? And then we can potentially go into the investor side. And I think there's probably no one better to really talk about what it takes to build the infrastructure for such a large number of users. With Joanne, you know, coming from Airbnb, Uber, and then obviously now Robinhood, maybe talk a little bit about your journey in terms of what you see from the perspective of user acquisitions from that perspective.
Yeah, you've done your research. So, you know, I think for us, for a very long time, crypto has been focused on just trading of assets, crypto-made assets. And so at some point, we're forgetting a lot about the actual technology behind it. And what we believe at Robinhood is that we can actually use this technology for a lot more things, from payments to actually transacting traditional finance instruments. And that's how we are really focusing on. Basically, for us, the idea of you buying a tokenized asset shouldn't be you have to create your own wallet with your private key, you have to pay gas fees, you have to bridge to a different chain. All this complexity, we need to remove it and abstract it away, and just focus on the actual kind of usage that people want to do. So, you know, for us, we have about 26 million plus customers, and our goal is to bring the other 100 million by really focusing on what are they trying to do and how do we give as much value as possible to the customer.
So maybe let's dive deeper a little bit into that. So as one of the leading fintech companies in the world, both from a regulatory perspective and obviously from a banking services side, how are you seeing some of the similarities and or differences between what a traditional kind of banking service provider now and the crypto service provider? What are some of the intricate similarities and differences that you see on that front?
Well, you know, I think there's a few different issues right now. The traditional system is still very slow. We just celebrated in the US moving from T+1 to T+2, the opposite, from T+2 to T+1. So that means that you still need a full business day to sell a transaction where you're buying stocks. And you know, imagine on a long weekend, you buy on Friday, you need to wait on Tuesday to actually get the receipt of your stock. And that's where we think the technology can really change things. By default, crypto is 24/7, fractionalization, instant transfer. So all of this can really reduce the cost of capital, reduce counterparty risk between companies, and at the end, all this cost saving can be actually pulled back to the customer, and the customer will have to pay less fees, or they will have to worry less about, you know, what can happen to their portfolio. There's a few things missing here. We need the regulatory clarity in a lot of places, including in the US. And we also need companies to start adopting the system. And we saw it with stablecoin. It took a bit of a while, you know, like the culture shift had to happen before people started to use it. But now everyone understands the efficiency and the benefit from a stablecoin. And so we want to bring that also for traditional assets like stocks, ETF, private equity, and more.
So how exactly does that work though, right? So you mentioned in the crypto industry, obviously it's 24/7, right? And with many trading venues all around the world in different time zones. With stocks, I know you guys have already tokenized more than 500 US stocks and ETFs and whatnot. So how do you actually synchronize between the traditional markets and then now a tokenized versions that potentially could be trading 24/7? So how does that work, both from a process perspective and maybe talk a little bit about the infrastructure side as well?
Yeah, so our main focus has been on our tokenization engine, really building a way to scale to any type of assets and any type of exchange. We started with the US. We have about 2,000 stocks token now. So really our goal was to make sure that we could give as much access to a wide array of assets, because nobody really want to have like just a limited amount of assets in their portfolio. And so, you know, for us, every time you buy a stock, every time you buy a stock token, we'll buy the same stock to make sure that we are always one-to-one. That's the most important part. If you remove the trust on an asset that is tokenized, you know, you're going to lose the market. And then during the market hours, obviously the price is pegged to what's going on in the market. And off market, we are making sure that we have enough liquidity providers and LPs and market makers to make sure that the peg is pretty close to the price. And obviously, you know, during weekends when there are big events, you will see volatility. But you know, nothing that is new, and you have the future market that is also allowing you to kind of making sure the price like stay pretty flat.
And are you seeing some unique requirements from the regulators in the markets that you operate in terms of how they would recognize in terms of how you're structuring this? Because obviously they're very used to the traditional markets and how that works. And now that you're moving things on chain and running 24/7, there must be some requirements that they might have instituted. So I'm sure you've had many of these conversations with them. I myself have many of these conversations as well. So what are some of the interesting things that you find in these conversations, let's say in the US or in the European markets?
Yeah, I think we're still at the very beginning. So in the EU, we have a derivative structure to make sure that we can actually tokenize as many things as possible. In the US, we're still at the beginning, I think, of the discussion. So, you know, the SEC mentioned that a tokenized security is still a security, which we completely agree with. You know, we don't think the crypto technology is a way to bypass the regulation. We think it's just a way to enhance the market and the capital. And so, you know, I think for us, at this point, we are fairly flexible. Our tokenization engine has been working for a while now, and we know that it's pretty easy to adapt. And it's more a question of like, how do we get past of this regulatory discussion? How do we get this built down in the US and in other places in the world, and actually get all the market makers and participants to embrace the technology? So, you know, right now you see a lot of announcements from NYSE, NASDAQ, DTC, all of these things, but no one is actually using it just yet. So, you know, we want to focus more on actually building and less about just like discussing.
So let's talk a bit about the number. Let's go back to the number a little bit, right? So we talk about the infrastructure, kind of the regulatory considerations that Robinhood is really focusing on. To get to 100 million users or above, obviously it's the US market, the European markets, the more developed kind of markets, but I'm sure you're looking into the developing and emerging markets. Are you looking into that as well? Because obviously they may have very different requirements, right? Like if you look at someone potentially from Africa or Southeast Asia, they might be looking at these tokenized products in very different light than a North American or European player. So what are you seeing that might be very unique in that regard?
Yeah, I mean, that's a part that we're the most excited about. You know, I think right now, if you think about someone in Africa, like you mentioned, or someone somewhere else in the world where they want to get access to the US stock market, usually they don't have a ton of choices, they don't have a ton of brokers that can actually even support their account, and then they will pay a lot of fees. And so we think that the tokenized version of our assets allows them to access it for the best price, and they don't have all this complexity to even open an account. The other part is on the other way around. Right now we talked a lot about the US stock market, but you could actually use the same technology for any type of stock market in the world. So from the London Stock Exchange to the Singaporean Stock Exchange or Hong Kong, since we're here. And so you give also access to the Americans or to the other places in the country to actually invest in those markets that otherwise it's very, very difficult to get access to. So I think it's going to democratize not just the access, but to the US market, but also to the other market in the world.
So I think that's quite interesting. So what you're saying here is potentially the term dual listing that we know of traditionally might have very, very different meaning now.
Absolutely.
Right? So not only geographical listing, but also from an off-chain and on-chain perspective. And you talked about potentially not only working with the more kind of US-centric financial products, but also products from other places. So if you look at it from that side, then are you, as a company, are you looking to democratize access to products across the board? Because I'm sure there's going to be a lot of friction and a lot of restrictions potentially, right? Either from the regulatory bodies or from other local exchanges and financial institutions that may not like that as much.
I think, as much as we've talked to regulators and to different countries, they are pretty excited about it because right now, if I ask you, how do you invest in a Nordic exchange in Europe, it's quite difficult. Even if you're a savvy financial investor, you don't have a lot of brokerage that allows you to do that. And on top of that, you have fees all the way. But at the same time, the Nordic countries, they want investment to come in. They want people to invest in their country. So you have like some wrapper mechanism, like ADR, for example, on the US market. But at the end of the day, it's still so difficult. And so I think that's where the beauty of the technology comes in. You will be able to access all these markets, and customer will be able to actually invest in things that they don't necessarily had access until now. And so I think in the term of energy, AI, all these things that are being developed, not everything is happening in the US, right? There's a lot of things being developed everywhere in the world, and so it will give a lot more accessibility to everyone. And at the end of the day, that's been our main focus for Robin, and we focus on accessibility, making sure that we remove the barrier to entry and reducing the cost to the end customer.
So you and I were catching up a little bit earlier before the fireside chat. You're here in Hong Kong for a few days, and then you're going to head to Southeast Asia. And I've noticed that recently there's been a number of acquisitions that Robinhood has made. I'm assuming, based on what you're sharing with us right now, that these are part of the strategy in not only growing that user base, but more importantly, gaining access to products that may be available in the local markets. Maybe tell us a little bit about that.
Yeah, that's right. We did a few acquisitions. Bitstamp, which is an exchange mostly focused on order book, deep execution, liquidity. We have crypto as a service that allows bank and other provider to offer crypto services to their customer. We also acquired a company, we announced the acquisition of a company called WonderFi in Canada, in Toronto. And so for us, it was the idea of accessing the Canadian market, not just the customers, but also having connectivity with market makers and exchanges there. And recently we announced the acquisition in Indonesia of two companies, one a brokerage and one is a crypto company. And so we are pretty excited about the Indonesian market. There is 13 million plus customers that invest in crypto over there. And we also think it's one of these markets where the exchange, for example, is very difficult to access, and we think we can bring a lot of value to their customer.
I mean, it is the fourth most populous country in the world.
It's a huge.
And I think I read somewhere that the median age is like under 35, right? For the entire population. So that's a massive market to really tackle. And I think it really plays to the point that you mentioned, gaining accessibility, right? For the young kind of working class in countries like Indonesia, how do they get access, right? Through very simplified means. We've got a few minutes left, so let me switch a little bit back to kind of your roots, right? Your engineering roots. And I recall that this weekend there was a news that I saw across the newswire about an exchange. Someone did a fat finger. Again, it seems like every month we see one of these, and a lot of the users were given thousands of bitcoins each. So it speaks to the potential of expanding beyond your scope and attracting new products, especially going on different type of infrastructure. But it also talks to the risk. So if you were to kind of wear your engineer hat back on, what are some of the things that you guys are doing to make sure those type of issues will never appear?
Yeah, it's a difficult one because, those issues existed for a very long time, except that crypto brings this instant and decentralized platform where in this situation, for example, if you get the 2,000 Bitcoin and you're fast enough to withdraw them, it's gone forever. And so back in the days, you will just reset the database and call it a day, and no one saw anything. So it's a very different world, and so we have to be careful. That's why Robinhood is usually not the first to launch product. We are very focused on how do we make it safe to our customer, how do we make it safe for the company. And so we spend a lot of time on doing red tests. For example, we have a team of hackers that are going to try to hack our system and making sure that we basically are bulletproof in many ways. But it is very important. At the end of the day, this is a new technology. People need to trust it. We had many issues in the past between Mt. Gox to FTX to other. And so for us, a lot of our focus is making sure that we bring this security so that customers don't have this constant fear of their assets. And at the end of the day, for a lot of customers, the solution is to decentralize and to go to self-custody. I don't think it's necessarily the answer, right? It's still very complicated to self-custody. You don't necessarily want to deal with it. And so I think centralized players still have a role to play here and just need to focus a bit more on safety first.
All right, so last question. I know we're coming up in time. Instead of asking you your projection over the next 3 years or 5 years of Bitcoin price or anything like that, let's stay away from that.
Thank you.
You have a few more days in Hong Kong. What are going to be some of the things that you look forward to doing while you're here?
Well, it's always super exciting to be here. I was here last year, and the enthusiasm at the conference was really big, and it was the first really big conference I did in Asia before Token 2049. And I think what's exciting is to see how much the local community wants to bring this technology here. So I think there is a lot more to do, and pretty excited to spend time here.
Excellent. Well, help me give me a hand to Johan. Thank you.
Thank you.
All right, great job, you guys. If you don't mind, I think our photographer would like to get a shot of you two good-looking gentlemen. Fantastic. There we go. And let's see, are we changing up the furniture? We are. Okay, good. Hopefully our boys are standing by. There we go. Merci encore, Johan. C'était vraiment super. Sean, thank you very much. There we go, fellow Canadian. That's what I like there, Sean Lee. All right, so very good. So we are moving on now with our next speaker. He is Corey Liu. He is the head of APAC for Duro Labs, who are developing the Pith network. He was with Paradox, and so he is going to be coming to speak to us today. He's got a great smile and a great message for us. Please welcome Corey Liu of Duro Labs and the Pith network. Corey, let's go. There you go. All right.
All right, hey everyone, I'm Corey Liu. I'm head of APAC for Duro Labs, and we are building the Pith network. I'm here to tell you today about a $50 billion industry. Let me start by asking a question. How many of you know these following companies? Bloomberg, LSEG, FactSet. Most people outside of finance don't know these companies, but I'm sure most of you know these. But what if I told you that combined, they are worth over $180 billion. And no, they are not AI companies. But what do they do? What makes up this valuation? Financial market data. Here's another question. How much do you think companies spent on financial market data in 2024? $1 billion, $2 billion, $10 billion? I'll give you a hint. If you had invested in financial market data 25 years ago, you would have outperformed the following assets. Gold by 2x, the S&P by 7x, oil by 18-fold. Financial market data generates over $50 billion annually. The cost of market data has increased more than 15-fold in the last 25 years. So you might be wondering, why? Isn't the price of Bitcoin, Nvidia, gold just public information? Can't we just type this into Google and just find the price? Well, the answer is quite simple. Data quality. High quality data is extremely valuable because low quality market data leads to people getting ripped off. How do you know you're getting the best price for something? how do you know you're getting the best price for even the most simplest of assets, like a cauliflower? All right, technical difficulties. Yes, we're waiting for the video to kick in. All right, pretend there was a video about various different cauliflowers, and there is a difference between the quality of the cauliflower. So pretend you're at the supermarket with your husband and wife, and then the wife picks a piece of cauliflower. Obviously, it's the best cauliflower in the supermarket, but the husband picks it, and it's the worst cauliflower. So the point of the video was supposed to show that there is a variety of quality data of quality cauliflower. So connecting back, quality data is worth a premium, but historically it's been fragmented and inaccessible. PIF aims to provide the highest quality data for the lowest possible price. How, you ask? That's a great question. A new economic model for market data through blockchain innovation. Let me show you what the old model used to look like. So for context, before this model, let me define market data. Market data is the price to buy an asset and the price to sell an asset. Effectively, it's a bid ask and you have a mid price, right? So this is a list of traders, banks, HFTs, firms, etc. These are the counterparties that are providing liquidity and giving you a price. So these institutions, they connect to the exchanges and the various geographics of them and all of the products. So the next step looks something like this. Whoosh, a lot of different connections out here. And very convoluted. Then afterwards, these exchanges specifically connect to the distributors. So you have the Bloombergs, the Refinitives, the FactSets, etc., that take this data individually and then repackage it and sell it back to the institutions. But afterwards, the institutions are forced to aggregate the data again. So adds another step into the process. So that's what it looked like before. So let me show you what the new model will look like. Okay, so we have PIF acting as a price layer. So notice on the trader side, on the flowchart here, it is directly streaming into the price layer, and the exchanges are directly streaming into the price layer, leading to, for us, for PIF to aggregate the market data, and then we can sell an aggregated high-quality stream back to the institutions providing better data. This combination of quality, quantity, and cost has never been possible before. We have a chart here. So there are many exchanges here showing fragmentation and lower quality, but higher quality for higher costs, obviously. But if we add PIF into this, boom, low cost, high quality. So to give you some context, we launched PIF Pro about 2 months ago. It is designed to be the ultimate subscription for financial market data, but built by and for institutions. It's like Spotify, but for market data. One subscription, one fee, every asset class, updated every millisecond, sourced from the best traders in the world. And the best part, it's 10 times less expensive than anything else on the market. Since launch, PIF Pro already has 10 weekly institutional inbounds, over 80 active subscribers, and over 1 million ARR in the first month. And we also we've empowering all of the popular RWAs that you've been seeing on centralized exchanges. Think of Binance launching their new silver perps, HIP3 markets across Hyperliquid. We've empowering all of that infrastructure with our new customer base. So connecting this back, going back to, let's say, did you know that less than 5% of software sales companies have achieved 1 million ARR in their first year of monetization? And we have already achieved that at PIF. So this is just the beginning. If PIF manages to capture 1% of this $50 billion industry, that's $500 million in annual revenue. But where does that revenue go? That's a good question. It goes into the PIF reserve, a tokenomics update designed for systematic value accrual. How does it work, you ask? Subscription revenue flows into the PIF DAO. The PIF DAO buys PIF tokens on the open market. The purchased PIF is held in the PIF reserve. This is what the flow chart will look like. All the revenues from PIF Pro, PIF Core, Entropy will flow to the treasury, and then a monthly percentage is purchased PIF on the open market into the PIF reserve. More production adoption, more product adoption equals more network value. Institutions are willing to pay for PIF data, and now the value will flow to the PIF ecosystem. For more information, please scan this. If you are an institution that would like to test their data or provide data to the PIF network, I would love to connect with you afterwards. Thank you, everyone.
Corey Liu, thank you so much. Great job today. All right, wonderful. Make sure you do check out the PIF Network. Come and talk to Corey if you want to find out more. With that, we're taking a little break. We'll look forward to having you back in your seats at 1 p.m. because we will start like a couple of minutes right after that, ready with a lineup of dynamite panels for this afternoon. So in the meantime, grab a bite, and we'll see you back here in an hour. I'm Andrew Work. Thank you.